Getting approved for a mortgage can seem overwhelming, but it doesn't have to be. As a matter of fact, it's pretty simple once you know what we're looking for. Here are the 3 keys your loan officer will need to review in order to get you pre-approved for a mortgage. Now, the first thing we're going to look at when we get you approved for your mortgage is going to be your credit report. Now, these are going to be different than the credit report you see from Credit Karma or the reports you get from your credit cards or your banks. They use a different scoring method, and so the scores are never going to be the same. Speaking of credit scores, that's going to be the first thing we look at on that report. It's going to be, does that credit score fit for the loan program that you're trying to use? Now, the basic rule when it comes to credit scores is that the higher the score, the better the interest rate that's going to be available to you. Now, if you have lower credit scores, there are loan programs that are available for you, and there are also tools that your loan officer can use to help you show how to improve your credit score, so maybe get you to qualify for a better loan program if you're not in a rush. After we make sure we have the right credit score for the program that we're trying to use, we're then going to take a look at your credit line history, the trade line histories. That's how long have you had them? What's your payment history like? We look for things like, do you have student loans that are deferred? The next part of that is also when we look at your total minimum monthly payments. And when we talk about minimum monthly payments, we're not talking about the payment that you choose to make each month, because I know a lot of people make larger payments than just the minimum because they want to pay their cards down faster. But for the mortgage purposes, all we're required to look at is that minimum payment that comes out on your bill each month, and that's what we qualify you with. Another thing we want to look at when we look at your credit lines is we look for installment loans that have less than 10 months left to pay on them. Because if you have less than 10 months left to pay on them, we could potentially omit those from your overall monthly debt, which means you qualify for a higher payment and could qualify for a higher mortgage. Another thing we look for in the credit report is going to be your derogatory history. So that's late payments, charge-offs, collections, things of that nature. When we look at things like late payments, we want to know how long ago were they? Do you have any in the last 12 months? And when it comes to collections and charge-offs, you don't necessarily have to pay them off. That's a common misconception. Depending on the loan program and the type of property that you're buying, we could potentially use a 5% payment of the overall balance and use that towards your monthly debt in order to qualify you for the purchase. And you don't have to pay it off, so you keep more money in the bank. One big positive change we've seen a lot recently comes with medical collections. Now, medical collections, if they're under a certain dollar amount, usually it's $500, they should not be showing up on your credit report. But most programs nowadays don't even really care about medical collections. They allow us to omit them and not include them in your overall monthly debt to income ratios. The last piece of that derogatory history that we look at is going to come down to public records. So that's generally things like bankruptcies. Do you have any government debt, liens, things like that? When it comes to bankruptcies, we want to know what type of bankruptcy you've had. Is it a Chapter 7 where they wipe out your debt, or is it a Chapter 13 where you're making payments to pay it back? If it's a Chapter 7, has it already been discharged? If so, you're probably going to have a waiting period of 2 to 4 years. Now, when it comes to a Chapter 13, if you're still in the repayment phase, you can actually potentially get approved for a home purchase. You have to get that approved by the trustee of the bankruptcy, but if you've had good payment history and you have at least 12 months of payments being made, you can potentially get approved for that FHA mortgage. One of the other major pieces of getting approved for a mortgage is going to be your income. What do you do for a living? How much do you make? If you're a W-2 employee, are you hourly? Are you salary? Do you get bonus income? How often do you get it and why? If you get overtime income, do you have a history of getting that overtime income? How often do you get it? Is there consistency with that? When it comes to bonus and overtime income, we're always going to look at the worst case average. So if you had been employed for 3 years with somebody, they're going to look at the previous 2 years and the current year to date, and they're always, or at least 99.9% of the time, going to take the worst case scenario when it comes to that average of income. So just so you know, for example, I have a client right now who has made amazing money this year when it comes to overtime, but the last 2 years were rough because of COVID. Well, we have to average all 3 of those years together in order to get that usable income. So it's really important that we look at the bonus and the overtime income from over the course of history and really be prepared to average it out. Now, are you self-employed? If you're self-employed, have you been self-employed for at least 2 years, or do you have a history in the field and then you move to self-employed in the same field for at least 1 full year that we have tax returns for? How's your business structured? Are you a S Corp? Are you an LLC? Do you file as self-employed on your 1040? By knowing how your business is structured, we know what sort of documents we need to request from you. One nice thing is that if you've been self-employed for at least 5 years, we can potentially qualify you off of 1 year of tax returns. Again, it depends on the loan program you're using, but depending on the loan program, we can look at 1 year of tax returns. So let's say you write off a lot of those expenses, you could potentially write off less in order to show a little bit more taxable income. Take it on the chin, pay a little bit higher taxes, but by showing more income, you can qualify for more house. Then once you buy the house, you can get right back to being aggressive and writing off as many of the expenses as possible. If you're a contractor, you need to have a history in the field and you have to have an active contract in order to really use that income. Now we are, like I said, we're going to look at 1 year or 2 years of tax returns depending on how long you've been in business. But one nice thing about being self-employed is there are things we can add back in, whether it's depreciation or different business expenses. So we want to make sure that we have all the tax returns up front in order to calculate your income accurately. Now, when you're retired, we're going to take a look at what forms of income come in. Do you have Social Security? Do you have a pension? Those things are usually pretty flat and fixed. We need a pension award letter or a Social Security award letter. If you have 401ks or IRAs, we need to make sure that you have distributions set up for those assets and that those distributions are going to continue for at least the next 3 years. The last piece of the puzzle that we're going to look at when it comes to getting you pre-approved for your mortgage is going to be your assets. When we're talking about assets, that means any funds that are going to be used towards the transaction, whether it's going to be for down payment or costs, or to be used as reserves, which shows extra money in the bank to strengthen the file for your underwriter. So when it comes to your assets, we need to have tracking on it. So when it's your own personal money, so money you had in the bank, we need to have it there for at least a full 2 months. It's called seasoning. I need to have that cash there. And we don't want to have any big deposits. So let's just say you had money in the bank, like I mentioned, no mattress money. You can't have mattress money. So let's say you had some money in a safe. I don't want to see that big deposit. So what that means is get it in the bank ahead of time, plan ahead so the money is there, and I don't see that deposit on at least 2 statements. Now, let's say you've been paying in a retirement account over the years. It's really great that you have that asset, and you can definitely use that towards your purchase transaction as well. Now, you have 2 options. You can either liquidate those accounts or you can get a personal loan against them. If you liquidate the accounts, there are taxable implications. And so you need to make sure you speak with the fund administrator and you find out exactly how much you're going to pay. Usually liquidating them doesn't make sense, but sometimes it does. You need to talk to your fund administrator, the person who runs that retirement account, to find out what those implications are and how much it's going to cost you. But let's say you want to get a loan against them. These actually work out pretty well because I don't have to count that payment towards your debt to income. You're actually going to pay yourself back, and you're going to pay yourself back interest. And the fund is still going to be there. So when you're ready to retire, you won't have liquidated it. You'll still have that money there for yourself to use in the future. One important thing to know, though, is that even though you have a lot of money in that retirement account, you usually cannot take 100% out. Generally speaking, if you're taking that loan out, there's going to be a limit on how much they're going to allow you to take a loan out for. So really important that you talk to that fund administrator, whoever runs that retirement account, and find out exactly how much is available for you to take on a loan before you start planning for your home purchase. One asset that a lot of people don't think about are gift funds, and that's money from family members. Now, generally gifts do have to be from family members, but it can be your cousin, it can be anybody that's actually in your quote-unquote direct family. So you're okay using money from an aunt or an uncle. I've had that happen before. Grandma, grandpa, parents, brothers, sisters, that sort of thing. In order to track those gift funds, the first thing we're going to need is going to be a gift letter. And that basically says that you're not going to have to pay that money back, that it is a true gift from the family member that's giving it to you. Depending on the type of loan, there are going to be some additional documentation required. So if you do an FHA or a USDA loan, they're going to need a bank statement from that gifter showing that the money was in their bank and that it wasn't deposited into their bank recently. If you do a VA or a conventional loan, it's actually a little bit easier. All they need to do is get what's called a wire receipt showing that the money came directly from the gifter's account to typically escrow. You don't want it to go into your account if you can avoid it. I don't want to have, again, those big deposits. So have them wire the money directly to escrow, and that wire receipt generally serves as the sourcing for that gift. Another thing that's actually pretty common I've seen is you sell an asset. So you sell a vehicle, a motorcycle, etc. I need to have a paper trail, so we need to have a bill of receipt, and then the deposits need to match the sale and the receipt. So I don't want to have a big difference in how much you deposit in the bank from what you actually sold that asset for. The last thing comes from when you're actually buying something from a family member. Sometimes you buy homes from family members and they can give you what's called a gift of equity. Basically what happens in that situation is they discount the price and they give you some of the proceeds from the sale and they put it towards your down payment on the property. There are taxable implications for the seller, so they need to talk to their tax person before they make that decision. But as a buyer, there are no tax implications for you. It's just a great gift that the family member can give you. It ends up giving you a lower overall mortgage payment because you have a higher down payment from the family member. In some situations, it can even help you get rid of mortgage insurance. So it gets you just a lot more affordable mortgage and potentially even a lower interest rate. Knowing what to expect when you go into the home buying process is a huge part of having a smooth, stress-free experience. Now that you know the 3 keys your lender will look at, you can make sure that you're actually ready to apply and you can get your mortgage approval moving immediately. Don't forget to like and subscribe for more tips and tricks for home buyers. And if you have any questions, drop them in the comments below or shoot me a call, 619-249-9140.